All right, let's jump right in with a little puzzle. How can two groups of numbers look totally different, yet somehow have the exact same average? And maybe more importantly, what does that little trick tell us about the hidden and often confusing world of financial risk?
Okay, so let's tackle this puzzle head on. Just imagine for a second that you're an investor and you're looking at two different opportunities. They're represented by these two simple sets of data.
And here they are. Take a look. On the left, we've got what we'll call set A. It is all over the place, right? Big swings from -10 all the way up to 30. But on the right, set B looks super calm. All the numbers are just huddled together. Right off the bat, they feel like complete opposites.
But, and this is the crazy part, if you actually do the math, add up all the numbers in each set and divide, you find out they share the exact same average, or mean, and that number is 10.
So that leads to a really important question. If the average return is identical, how on earth do we explain the wild roller coaster of set A versus the smooth, predictable path of set B? How do we measure that turbulence, that risk that the average completely misses?
To figure that out, we've got to look past the average. We need to start measuring something that statisticians call dispersion, which is really just a fancy way of saying how spread out the numbers are. So let's build our toolkit.
The first, and honestly the simplest tool we have, is the range. It is exactly what it sounds like. You just take the biggest number, subtract the smallest number, and boom! It gives you a really quick snapshot of the total spread.
And wow, when you look at our two sets, the difference is just massive. Set A has a range of 40, while set B's range is only 4. That's a 10 times difference, and it's our first big clue that set A is way more volatile.
But range only looks at the two extremes. To get a much clearer, more robust picture, we need a more powerful tool called variance. Now this is cool. It doesn't just look at the bookends, it measures how far every single number is from that average of 10.
Now, the calculation might sound a little intimidating, but it's actually pretty straightforward. Here's how it works. First, you just see how far each data point is from our mean of 10. Then, and this is the really clever part, you square that distance. We do that to make all the differences positive, so they don't just cancel each other out. After that, you just add them all up and find the average. It's a really brilliant way to capture the total deviation.
And when you actually crunch the numbers, the results are pretty staggering. Set A has a variance of 200. Set B, just 2. That's not 10 times bigger, it is 100 times bigger. Now that paints a very clear picture of risk. Okay, our last tool is probably the one you've heard of, standard deviation. And really, all it is the square root of the variance. Now you might be asking, why bother with that extra step? Well, it's super useful because it brings the number back down to a scale we can actually understand and compare to our original data.
So what does this all mean? When we boil it all down and take the square root of the variance for both sets, we get our answer. Set A has literally 10 times the standard deviation of set B. This just confirms what our gut told us from the very beginning. It is 10 times more spread out, 10 times more volatile.
All right, that was the theory. Now let's take this new toolkit of ours and apply it to the real world, shall we? We're going to compare two major US stock market indices to see exactly how these ideas play out in real life. So on one side, you've got the S&P 500. This tracks 500 of the biggest, most stable, household name companies out there. And on the other side, we've got the Russell 2000. It tracks 2,000 smaller, often more unpredictable companies. So which one do you think is the riskier bet?
This chart right here is a perfect picture of what we're talking about. When we say volatility in finance, all we mean is how much a stock's price, that's the blue line, is jumping all over the place around its long-term average trend, which is that orange line. You can really see those big dips and climbs.
Now, financial pros have a few different ways they measure this stuff. For our comparison, we're going to focus on 3 key ones. We've got the high-low price range, we've got the distance from a moving average, think of that as how far it strays from that orange line, and of course, our good old friend, the standard deviation of its daily returns. And guess what? When you run the numbers for all 3 of those tools over the last 10 years, the story is exactly the same no matter how you slice it. The Russell 2000, that index of smaller companies, has been significantly more volatile than the S&P 500.
Crystal clear. So what's really cool about all this is that we can take this entire analysis and wrap it up into a simple, reusable tool. And that lets us compare the risk and the return of pretty much any investments we're curious about.
Check this out. Here's our tool in action, looking at data since the start of 2020.
First, look at that last column, daily return percentage. You can see the S&P 500 had a higher average return. Okay, now look at the two volatility columns. In both cases, the S&P's numbers are lower. I mean, getting a higher return with less risk? That's pretty much the dream for an investor during that time frame.
But here's where a tool like this gets really fun. It's totally flexible. Let's throw a single massive company into the mix, say Apple, and see how it stacks up against the whole market.
And this right here, this shows you the fundamental trade-off in all of investing. In this period, Apple delivered more than double the daily return of the entire S&P 500. Incredible, right? But to get that much higher reward, investors had to put up with significantly higher volatility. It was a much, much bumpier ride.
And that really brings us to the final question, and it's a personal one. There's no such thing as the single best investment. There's only the investment that's best for you. Are you trying to climb the highest possible mountain peak and you're willing to handle that treacherous climb? Or are you looking for the calmest, smoothest, most predictable river journey? Understanding the difference between an average return and the true volatility is what gives you the power to choose your own adventure.